Welcome to today's pre-market explainer. Let's dive right into the macro drivers shaping today's session.
Equity futures are pointing sharply higher this morning, led by a massive 232-point surge in the Nasdaq. After yesterday's broad losses, traders are already reverting to a very familiar reflex: buy the dip.
We've got three main catalysts driving this upside bias and broad market support ahead of the bell.
First up, there's renewed excitement over Q1 megacap earnings and some serious ongoing momentum in AOF.
Second, markets are pricing in hopes that the Strait of Hormuz blockade eases up, stabilizing crude oil.
Finally, we just got the April jobs report. Let's break down these highly anticipated numbers together.
April non-farm payrolls jumped by 115,000, easily crushing the consensus estimate of 67,000.
The headline unemployment rate held perfectly steady at 4.3%, exactly matching what the market expected.
And the average work week actually ticked up slightly to 34.3 hours, beating consensus estimates.
On the surface, that looks really solid, but let's take a closer look under the hood here.
March payrolls were revised slightly up, but February saw a nasty downward revision to negative 156,000.
Crucially, the U6 unemployment rate, which includes underemployed workers, actually increased to 8.2%.
On top of that, the overall labor force participation rate dipped slightly to 61.8%.
Plus, average hourly earnings growth came in weaker than expected, rising just 0.2% for the month.
This brings us to a massive macro friction point: sticky inflation's impact on real earnings and interest rates.
Year over year, nominal average hourly earnings are up a seemingly healthy 3.6%.
But when measured against the March CPI report, real earnings are up a mere 0.3%.
And against the latest PCE price index, real earnings are up just a microscopic 0.1%.
This means consumers have almost zero discretionary spending cushion left without taking on debt or tapping savings.
So, the million-dollar question is, without real wage growth, how long can this discretionary spending hold up?
Keep these constraints and rate expectations in mind as you set your risk parameters today. Good luck trading.